We've learned the theory. Now's the right time to provide a great example, right? How about one of the biggest IPOs that we've seen in recent years? Facebook. The company, founded by Mark Zuckerberg and a few of his Harvard classmates, resisted takeover attempts for years. Zuckerberg turned down a $75 million acquisition offer in 2006 and a $1 billion offer later in the same year when Yahoo tried to buy the company. After a few rounds of investments, in 2012, Zuckerberg was finally convinced that the website is ready to go public. One critical question that investors wanted to understand is, how does Facebook make money? Of course, it had a huge user base of almost 900 million people at the time of the IPO filing. But the unknowns were plenty. Is the company going to be able to shift successfully to mobile phones? How is it going to sell ads that will be displayed on mobile phones? Is it going to be able to monetize its huge user base? Of course, it was obvious that Facebook had plenty of upside. Advertisers tend to be attracted to Facebook because of its massive reach, high user engagement, and ability to target ads at specific users based on the information they provide, which is pretty much every advertiser's dream. Facebook's revenues grew at an amazing pace. The average growth of sales between 2006 and 2011 was above 140%. That's precisely what investors are looking for, remember? They want to buy the shares of a company that has an amazing growth potential, precisely like this one. What about profitability? With a net income of $700 million and an EBIT margin of 47%, it was pretty obvious that the company is ideally positioned to capitalize on its growing revenues and improve its margins even further. Throughout the roadshow, Facebook's stock valuation increased. In early May, the firm looked for a valuation in the range of $28 to $35 per share. But on May 14th, it decided to go with a higher target, $38 per share. Of course, a company like Facebook isn't IPO'd every day, and demand was high. Some investors were even willing to buy shares at $40. Facebook was a long-awaited IPO. The firm is very famous among retail investors, which is a very encouraging signal. So, when IPO day came on May 14th, Morgan Stanley, who were Facebook's global coordinators for this deal, suggested a price of $38 per share. And this is very, very close to the maximum price suggested in the book-building phase. The company was valued at a stratospheric $104 billion, as it managed to sell 4.8% of its capital for $5 billion. After the IPO, the company's price went south for a significant amount of time. By the end of May 2012, the stock had lost more than 30%, reaching $25.50 per share. Investors who participated in the IPO were, of course, more than unhappy. Some important finance commentators labeled the IPO a fiasco. Fortunately enough, the story doesn't end there. A few months later, the company's solid fundamentals and growth perspectives convinced investors that this is one of the most valuable businesses in the world. In 2018, 6 years later, the company's stock price trades above $185 per share. So what is the lesson then? Was this a successful IPO? Most definitely it wasn't. But how come, one could ask? If I had bought one share at the day of the IPO and held it up until now, I would have made 4.5 times my money, which is pretty remarkable in a 6-year time span. Yes, that's true, but investors were left with a sour taste after the IPO, and this is something that should never happen. A company wants to keep its investors happy. One of the principles to do that is to apply a slight discount at the day of the IPO. Instead, the company's ownership opted to sell at the highest range they could, which ultimately hurt the stock price for a few months. Of course, over the long run, business fundamentals are more important. But I can also assure you that there are plenty of institutional and retail investors who bought in at $38 per share and sold at $26. A horrible scenario in an IPO. Valuation is a tricky topic, that's true. But market sentiment and book building indications are the perfect tool that allows bankers to suggest the right call to their clients.